All sports organisations, whether professional clubs or grassroots teams, need money to survive, grow and thrive. Some clubs bring in revenue through ticket sales, merchandise or reinvestment. Others rely more heavily on external sources like sponsorship, grants or fundraising events. But as clubs grow, the financial strain often increases. Trading clubs might struggle to fund further expansion, whilst volunteer-led teams may hit a ceiling with what membership fees alone can cover. So, how do clubs find the right funding strategy? In general, funding falls into two categories: commercial and non-commercial. Non-commercial finance often comes from grants or donations and supports community-driven goals. Commercial finance, on the other hand, is all about return on investment, and it's especially relevant for professional football clubs. Let's take a look at 4 key types of commercial finance in sport. 1. Bank loans. Bank loans are one of the most common ways to raise funds. Clubs can apply for personal loans for individual investors or business loans to grow operations. Short-term overdrafts can help manage cash flow, but they often come with high interest rates. Larger, structured loans typically offer lower rates, but they require solid business plans and repayments based on projected revenue. Miss a repayment and it can limit future borrowing, or worse, push the club towards insolvency. 2. Debt financing. Debt financing is increasingly common at the elite level of football. Here clubs borrow against future revenues, whether for signing players, upgrading facilities, or launching new commercial ventures. It's flexible and repayment terms can sometimes be renegotiated, but the risks are high. Interest rates can be steep, and unless the club stays profitable, debt can spiral quickly. In the worst case scenario, it could lead to administration collapse. Still, many clubs see it as a way to scale up, providing they manage it well. 3. Leasing. Leasing lets clubs access important assets like stadiums, training facilities, or high-cost equipment without huge upfront costs. Instead of buying, they pay to use. Let's take West Ham United for example. Since 2016, they've leased the London Stadium for around £3.6 to £4 million a year. But that doesn't include maintenance or utilities, which are covered by the stadium's owner, the London Legacy Development Corporation. Leasing helps clubs stay flexible, but they don't own the asset, which can be risky if lease terms change. 4. Share issues. Some clubs raise funds by selling shares, either to existing shareholders or in rare cases through public stock exchanges. There are 4 main ways to issue shares. Rights issues. This is where existing shareholders buy more shares, often at a discount. Public issue. This is where shares are sold to the public. Offer for sale. This is where shares are sold to an institution that resells them. And placing shares. This includes private sales to select investors. Publicly listed clubs like Manchester United, Juventus and Borussia Dortmund raise large sums this way, but with an increased financial scrutiny and exposure to market risks. Alternative finance options. Not every club wants or is able to use traditional commercial finance. Let's explore a few alternative models that are gaining popularity. Public-private partnerships, or PPPs. PPPs are collaborations between clubs, private investors and government bodies, usually to build or operate major facilities. The public side focuses on access and community benefit, whilst the private side brings funding and commercial know-how. The challenge? Balancing public accountability with private profit. When done right, PPPs can create high-quality, multi-use facilities that benefit everyone. Bonds. A bond is like a loan from the public. The club promises to repay the investment after a set period, with interest along the way. Bonds let clubs raise money without giving up control or ownership. Once used mainly by elite clubs, bonds are now more accessible, thanks to crowdfunding platforms and mini bonds that invite fans to invest directly. Community shares. Community shares are unique to clubs set up as community benefit societies, like AFC Wimbledon or FC United of Manchester. Supporters buy shares not for profit, but to help the club grow whilst keeping ownership in the hands of the community. Every shareholder gets one vote, regardless of investment size. There's usually no dividend, and shares can only be withdrawn under specific circumstances. The benefits: clubs raise money without outside control, whilst building stronger supporter loyalty, increasing chances of obtaining grants, and boosting financial flexibility. From bank loans to bonds, community shares to PPPs, there's no one size fits all to funding sport. Every club needs to consider its goals, risks, and community when choosing a finance strategy. So whether you're a large professional club or a local grassroots team, choosing the right financing is key to long-term success.